You know, we're now in January 2023, and you know, interesting enough, the stock market has had one of the worst years in a very long time. And I seen a headline the other day, and it said $12 trillion has been erased from the US stock market in 2022. And I really wonder if most folks kind of wonder, where did all that money go when they say erased? You know, there was a time that my thought on when the stock market went down that, you know, person A was selling their stock, person B was buying it at a lower price than it was the day before. So person B was actually gaining person A's money. Does that make any sense? Well, I kind of thought that at one point. But I started really thinking about it, and in reality, that $12 trillion basically disappeared into thin air. Because when one person sells a stock at $1, and then the next folks that buy that stock buy it at 95 cents, that 5 cents is gone. It has disappeared in thin air, and it will never be returned. Now you say, okay, what happens if the stock price goes up? Well, person B who bought it at 95 cents, if 5 months down the road that stock is trading for $1.50, obviously that stock trader has made 55 cents, or I shouldn't say made, but his investment has appreciated by 55 cents a share. So he is better off than he was. The guy that sold him that stock at 95 cents, his money that he has lost on that stock is gone forever. He can never get that money back. That's what, and that's because that money has basically disappeared into thin air. And some people will argue and say, if you sold your stock at $1.20 and then held the money in your account, and then all of a sudden the stock was at 80 cents and you bought it back, have you made any money? Well, no, you actually haven't made any money. You now would own more stock than you did when you sold it at $1.20 if you bought it at 80. But you know, until you sell it again at a higher price, you still haven't really made any money. So that brings me to another question. Think about this. If nobody sold any stocks in the whole year of 2022, then that $12 trillion wouldn't have disappeared in thin air. So does that make you think? So that brings me to the conclusion that the stock market is basically, I won't call it corrupt, but it is manipulated in the sense that somebody has to start selling to make stocks and the prices go down, because somebody sells a stock, the person that's looking to buy offers them less than the current price, and then all of a sudden the stock is worth that much less. And if you continue that mechanism over and over again over a period of months, then eventually a stock can go from being $200 a share down to $140. But you say to yourself, why are people selling at a loss? Well, not everybody is. if somebody had bought, say, Amazon at $100 5 years ago, and I don't know exactly what the price of Amazon was 5 years ago, but say it was 5 years ago, it was $100, and then, you know, in the middle of 2022, the stock was worth $450. Okay, so that person has made a lot of money on that stock. So all of a sudden, people start selling that stock like people did in 2023, and all of a sudden, that guy's stock holding for Amazon is now worth $350 a share. So he's saying, you know what? I made a lot of money on this stock. I still think that prices are going to go down and people are going to keep selling. So I'm going to unload it. So that guy has made a profit. The people who get hurt are the ones that buy near the top of the market. And the people who are selling at the top of the market are generally the hedge funds and the big investment brokers and the Warren Buffetts of the world. Those are the folks that are selling their stocks when the prices are very high and they have a lot more knowledge of how the markets work. And unfortunately, when they're doing that, the people that are buying those stocks are usually retail investors, you know, your mom and pop stock holders that handle their own investments. And don't get me wrong, could still be, you know, large hedge funds. Not all of them get it right, but generally it's the less sophisticated investor that is selling or buying stocks on the way up and nearer to the top of a market cycle than the more sophisticated investor is. So unfortunately, as stocks go down, there are people that make money, and then there's people who buy in and they shouldn't have. And then when the stock drops 20-30%, you know, they've lost a lot of money on paper. And what you need to do in those situations is you need to hold on. You know, you need to just, you know, hold on to that stock, because if you look at the stock market, you know, at a chart of the last 50 or, you know, 75 years or whatever, through all the different cycles, the markets have always come back, always. So what's the rule, or what's the common sense approach to investing to make sure that your money doesn't evaporate into the markets? Is hold on. Don't sell, you know, when everything is in turmoil. As a matter of fact, you know, if a stock has dropped 10, 20, 30%, and it's a company that you like and believe in, if it's a company that has a big moat, so, you know, they sell a lot of products to a lot of people in a lot of parts of the world, or a service to a lot of parts of the world regularly and profitably, then, you know, if it's down 20% or 25%, buy more of it. You believed in it when it was $150 a share. Why wouldn't you believe in it when it's $120 a share or $100 a share? And that is one of the secrets and one of the ways that sophisticated investors, you know, and even unsophisticated investors build wealth in the stock market. We've all heard the expression, buy low, sell high. Well, that's a perfect example right there. You know, you buy stocks when they're lower, and then, you know, you try to you know, sell them at a profit. And some would say, you know, trying to time the markets is wrong, and I wouldn't disagree, but you might do what they call rebalance. So when when you've bought a stock at $100 and all of a sudden it's $180, well, then maybe it's time to sell some of that stock and look for a stock that might not be doing as well at that particular time, but it is a good sound company, and for whatever reason the price of that stock has come down. It could be because of a earnings miss. It could be other news that comes out to the public, a recall if it's an auto company or whatever the case may be. But you know, stocks can get trounced for lots of different reasons, and you know, the company can be a valuable company, and in the long run it's a good investment. I mean, you know, one company that has just got completely trounced in the last 2 years is Facebook, and how a lot of it has to do with their investment in the metaverse. And in reality, Facebook is a sound profit-making machine. This company brings in so much free cash flow, it's staggering, and it's a stock that I own, and I am down on my holding of Facebook, but I'm going to hold on because I believe that in the long run it's going to come back and more. And you know, so that's what you need to do. You need to rebalance. When some of your stocks have done really well, you need to sell off some of them and then invest in some other companies that are on the other side of the scale. And if you can do that and be patient and methodical and have a plan, then you can do well in the stock market, just like the big guys. So anyhow, I wanted to do this video about the $12 trillion lost in the U.S. stock market, because I find it interesting, and I think a lot of people probably never really realized you know, how that side of it works. Because I know for the longest time I always thought, well, you know, whoever's buying it cheaper is making that money back, or getting the other guy's money, but in reality they're not. You know, the money is basically disappearing. So anyhow, please subscribe to my channel, hit that like button, and if you disagree, leave me some comments. If you agree, leave me some comments. Whatever the case may be, I enjoy reading them, and I enjoy talking to you. Thanks very much, and have a wonderful day. Bye for now.